I'm Dawson Schmidt here with the latest stories and developments in this week's Commodity Roundup on Trader PhD. U.S. soybean crushing set yet another record for the month in February. The National Oilseed Processors Association reported that NOPA members crushed 208.8 million bushels of soybeans in February, marking a 17% increase from a year ago. Crushings were lower compared to the previous month despite the year-over-year increase. Soybean crush margins remained strong, with spot margins surging ahead of the new year, supported by soybean oil prices. Soybean oil stocks at the end of February totaled 2.08 billion pounds, up 9.5% from the previous month and 38% higher year over year. The NOPA report continued to show strong crush demand despite building soybean oil inventories. Muted soybean export demand this season supported domestic processing. The USDA will offer a similar confirmation of that February data early next month. Below average snow and rain through the fall and winter have left much of the U.S. short on soil moisture, raising concerns for the winter wheat crop. According to the latest drought monitor, 55% of U.S. winter wheat areas are facing at least some drought, up from 34% a year ago. Crop conditions also slipped in March. USDA says 46% of the Kansas winter wheat crop was rated good to excellent as of March 22nd, down 6 points from the previous week. Oklahoma fell to just 14% good to excellent, the lowest for this time since 2018. Texas did improve slightly to 16%. The forecast stays mostly dry across the plains in the near term, but there is hope for better moisture next week. Nutrient Ag Solutions meteorologist Eric Snodgrass says if those rains materialize, they could go a long way in easing current soil moisture concerns. Still, he cautions that longer range forecasts often overpromise and underdeliver rainfall. With drought risks expected to linger into spring and summer, timely rains will be critical. If moisture remains limited, weather premium could continue to build into the wheat market. The latest USDA cattle on feed report delivered some bearish news for the cattle market on Friday, as both feedlot inventories and placements came in larger than expected. The March 1 feedlot inventory totaled 11.5 million head, down just 0.2% from a year ago. That was the smaller decline than what analysts had expected, suggesting cattle are staying on feed longer and keeping supplies more steady than expected. Placements in February are also surprised to the upside, rising 3.7% from a year ago to 1.6 million head. That marked the first year-over-year increase in placements since March of last year. Now, Texas, Oklahoma, Iowa, and Arizona all posted notable gains, while only Colorado and Nebraska saw declines. USDA livestock analyst Mike McConnell says that was largely due to impacts from the ban on Mexican cattle imports last year.
Relatively speaking, from a broader perspective, placements are still relatively low by historical standard. It continues the trend of still relatively tight inventories of cattle outside feedlots.
Meanwhile, February fed cattle marketings fell 6.8% from a year ago to 1.5 million head, the lowest for the month in roughly a decade. High cattle prices continue to slow the pace of marketings as packers try to protect already thin margins, a trend that is also helping extend days on feed. Thanks for watching. I'm Dawson Schmidt, and this has been Trader PhD.